Okay, so you've gotten in a number of offers in the mail with different rates, all of them claiming that they're going to save you some money on your mortgage payments. And so, how do you prove that? Well, in this video, we're going to show you how to do it. So hang tight. All right, so in this video, what we're going to do is we're going to explore the costs of getting a loan. All the how do the origination fees, points, those kinds of costs affect your real cost of that loan. So, for example, if they tell you you're getting a 4% interest, are you really getting a 4% interest? We're going to look at that. Okay. Now, this video was recorded a while back, but the content was really good. Also, was part of a much larger video. If you go down in the description below, you're going to see some links to that video. It's longer, but I recommend you watch. It's got a lot of really good material in it. Also, if you go down to the link below, you'll also see a link in there on how to actually step-by-step create an amortization table in Excel. So that's a really good video. I recommend you watch that as well. Now, I hope you like the video. If you do like the video, please give us a thumbs up, hit the subscribe button, and hit that bell notification so you get future videos. All right? Enjoy the video. Now, let's go over here real quick. I'm going to click out of that so we don't accidentally mess something up. Now, let's go over here. Now, in this particular case, if we take a look at our bank cash flow here, this is taken into account that this is how much money, this is taking out this $32,000 fee. All right, so watch this. So what we're going to do is we're going to come over here and we're going to say this is equal to our payment. Hit enter. Okay. And then once again, all the way down. Make sure it all the way went all the way down. All right. Now, commonly, let's take a look at how finances is looked at. So if you notice that there's a negative sign here and a positive sign here, and that's typically telling you which direction the cash is flowing. From the perspective of the person taking out the loan, they're receiving a loan. That money's coming at them, so it's positive. From the perspective of the lender, they spent the money, okay? So they're looking for flows to come back to them in a positive manner. All right. So what we're going to do here is we're going to do our internal rate of return, and we're going to look at that. So we've got an IRR, okay? And literally, we're just going to go all the way down and grab it. All right. Close parentheses. Now we're going to multiply this times 12 because we had to get that back in there. There we go. And sure enough, we've got a 4.29% effective rate. That's what the bank made off of your fee. All right. So now let's go over here and take the cash flows that you actually paid. So here we go. We're going to copy this over here. Well, this is going to be a negative number, right? Minus, and then we're going to hit that and then hit enter. And if you notice, it gave us a negative number because those cash flows are going away from us. Again, come over here and double click. All right, now we can analyze those cash flows as if there was never a fee in there. All right, so here's what we're going to do. We got our equals our IRR. All right, now let's grab all those payments. We're going to close that parentheses. Oops, excuse me. Shouldn't have done that. Let's go back here. Let's just do this again. Okay. Let's grab those parentheses times 12, enter. And of course, that matches what we actually paid in our interest rate. Makes sense, right? Now, let's take a look at the net present value. And what that is that's looking at all the value of all your cash flows in the dollar amount. All right. So here we go. Now, Excel does something very interesting. They don't have a true net present value like you would find in a calculator. So what you have to do is you have to work around it real quick. So let's do this. So our net present value, we're going to go over here to G6 here. We're going to grab it. That's what our payment was going out, right? And then what we're going to do is we're going to add the NPV. And here, follow the instructions underneath it. It's got the rate. So we're going to come over here and hit our rate. And then what we're going to do is put our comma, and then we're going to do the values. all the way down here. All right. And then we come up here and we close the bracket. Now that's our net present value. Now let's just take a look at it here. Now in this particular case, here we go. Let me go ahead and get this done here real quick. I'm sorry. And there we go. We are going to hit our value here plus our NPV. Okay, take our NPV here, and we got our rate. We have our rate over here. And then we're going to drag these all the way down. And you're going to see something here in a second. It's very interesting. All right. If you take a look at the difference between these two values, the net present value of all those cash flows, you're going to notice that the difference is that $32,000. So in reality, what you did is you paid a 20 or a 0.23% surcharge to get that. You have to evaluate that later. We're going to go over a different video that goes over the incremental cost of capital and what the implication of all that is. So now we've already built this one. Let's go take a look at it and we'll experiment a little bit. In this particular case, this loan is actually a 30-year loan with the same terms. And if you notice that the NPV is different, same thing. So in this particular case, there's also no fees. So it's 4.06 and 4.06, which is what you would expect to find. All right. We're going to go over here to this number 3 here, and you see that it's the same thing, same terms. All the terms are the same, except now we're back to that $32,000 fee that was in there. And if you'll notice, the cash flows to the bank are a little higher than they were in the 240, which is what you would expect because that mortgage was out there longer. Okay. And the same thing here. Now, this one, I actually changed the interest rate, and you can see how that affected your cash flows. So the effective rate here was 3.16 versus 3.0 here. So you paid 0.16% difference in incremental cost, a little bit less than what you paid at the higher interest rate. All right, let's take a look at the results of all that. Oh, by the way, let's go ahead and get this done real quick. So we're going to have to build this table out real fast. Let me go in here and grab this for us. Same thing here. All right. Okay, so we can actually compare these now fairly easy. So in our first one, which is the demo, the term was 240 months versus the 360 months. And it was a 30-year mortgage versus, this one's a 20 versus a 30-year. And you can see how the fees came out a little bit different versus the fees as they came out in the constant payment mortgage loan with no fees. And the same with a 2% fee. And here it was just a change in interest rate. So what we map out is the cash flows coming from here. Okay. Now, one of the good things that you should do and get used to when you're constructing spreadsheets is you don't hardwire really anything except for inputs that must be inputted. Those can be hardwired. But what you want to do is leave things alone up in here to where all you have to do is change the function here. So let's say, for instance, I wanted to change this one to, we'll say 5%. We can do that. Notice how it all changed here. If we built this spreadsheet correctly, then the results should have come through over here, and they did. So I hope you enjoyed this episode here and you learned quite a bit. Stay tuned for the constant amortization mortgage and the variable rate mortgage, the graduated payment mortgage, and the interest-only mortgage. We're going to set them up very similar in nature with the spreadsheets as we have them. Okay, so some of the key takeaways that you had in this video is that costs affect these loans very differently depending on whether the fee is coming from you or from the bank. All right. So you saw those negative costs in there. Also, if you look in that last page of the spreadsheet and that first first case, I had the negative sign was backwards. So I know you're going to catch that. Somebody say something in the comments about it. That's where it's coming from. It should be actually positive rather than a negative on there. Okay. And as you remember, I told you that if a fee is, it depends on the perspective of where the fees are originated from. If it's leaving you, it's a negative cost. If it's coming to you, it's a positive cost. If you're a banker and you're paying it out, it's a negative sign. If it's coming to you in payments from the borrower, then that's a positive sign, right? Okay, so now also in this video, we only cover the constant payment mortgage. In future videos, you're going to see mortgages like adjustable rate mortgages, variable rate mortgages, graduated payment mortgages, interest-only mortgages, exotics of that type. And what you're going to find out is that these mortgage types are used as tools for cash flow. And also in future videos, we're going to show you how to compare those out and determine which one would actually fit you better. So stay tuned. Now, also on this end card, I'm going to put some more suggested videos up for you as well. All right, thank you very much.